In general, it's been another strong week for equity markets, particularly in the US, where a number of indices have reached record high levels, including the Dow Jones Industrial Average, which is trading now above 19,000. And as we can see from this chart, the S&P 500 has breached the 2,200 level. Interestingly, this strong equity market performance has been against a backdrop of a strengthening US dollar, where the US dollar index this week reached its highest level since 2003. And also, as the market implied probability of a December interest rate hike in the US, based on Fed Fund futures, is now showing at 100%. So what we've seen is a continuing of the momentum in the equity market in sectors such as financials, as bond markets have continued to sell off following the election of Donald Trump as president of the US. And this is evidenced in this chart here, where we can see the continuing performance, strong performance of the S&P 500, as we've seen a rise in bond yields in the US Treasury market. And this is as investors have continuing to choose to focus on the potential positive growth outcomes and higher inflation prospects from some of the proposed fiscal policies under a Trump administration. And they're focusing less on some of the uncertainty around other measures that arguably could be more damaging if enacted, such as the talked about protectionist measures around trade. Turning to this week in the UK, the focal point was, of course, the autumn statement from the Chancellor, Phillip Hammond. Going into the statement, the expectations for big giveaways and large fiscal stimulus had been reduced for a couple of reasons. Firstly, the relatively resilient performance, economic performance so far post-Brexit. But also the Chancellor arguably had little room to manoeuvre in this statement, given what he himself has referred to as eye-wateringly high levels of debt in the UK, and with a forecast of a slowdown in the economy over the next few years expected to worsen the fiscal position. We can see the debt in the UK, how this has risen significantly since the financial crisis, not just in nominal terms, but also as a percentage of GDP. In terms of the forecasts in the statement itself from the Office for Budget Responsibility, the OBR, for growth we saw a modest upgrade to the forecast for 2016, but significant downgrades for the next 2 years compared to pre-Brexit estimates. So now expecting 1.4% of growth in 2017, down from 2.2% forecast back in March. And 1.7% now in 2018, down from 2.1% at the time of the budget in March. And in terms of debt, the fiscal targets initially set by the previous Chancellor, George Osborne, are now viewed as unrealistic against the heightened economic uncertainty post-Brexit. And the government is no longer seeking to achieve a budget surplus by 2019-20. Instead, Mr. Hammond has given himself a rather looser target for returning the public finances to balance, committing to do so only as soon as possible rather than on a specific date. He hasn't totally rejected austerity, but he has given himself a greater degree of fiscal flexibility or fiscal headroom so that he can provide additional stimulus at a later date should that be required. In terms of the debt forecasts themselves, the OBR has increased the borrowing estimate by just over 120 billion over the next 5 years, and it now expects public debt will peak at about 90%, just over 90% in 2017-18, and to start falling towards the end of the current Parliament. Of course, a bigger borrowing requirement implies a larger amount of government bond issuance. And the challenge for the Chancellor going forward, if he doesn't want to risk borrowing costs spiralling out of control, is going to be to convince his investors that he is sticking to a credible plan to get the UK onto a sustainable path of deficit reduction. As we can see from this chart here, bond yields have risen. The bond yield did rise. Bond yields did rise on the back of the statement, and bond yields are significantly higher than they were back in summertime. In terms of the investment initiatives in this statement, this focused on 23 billion National Productivity Fund for funding innovation and infrastructure for the next 5 years. And there was also money earmarked for housing, for the housing market and some transport-related infrastructure spending, among some other measures. The increase in infrastructure spend, not just here but also in the US, is a key investment theme of ours. And I just want to pick up on a company that the equity research team believe could be a big beneficiary of this, and this is Hill & Smith. Hill & Smith is a company which applies infrastructure products such as permanent and temporary road barriers, as well as galvanizing services for steel, which is used in a range of structures, including bridges and frames for solar panels. They had a strong trading update last week and provided guidance for trading performance to be at the top end of expectations in 2016. So please do speak to your investment manager for the research notes on Hill & Smith and also for the most recent commentary on the company. Looking forward to next week, on the economic front, there'll be a focus on the US employment data on Friday. And the consensus forecast here is for 180,000 jobs to have been added in November. And if this is achieved, it will be seen as reinforcing the case for a rate rise in December in the US. There'll also be quite a lot of attention on the oil price, with the markets waiting to see if any concrete measures will come out of the OPEC meeting on Wednesday. And of course, with the US markets closed yesterday for Thanksgiving, that means that today is Black Friday and the start of an important trading period for retailers in the lead up to Christmas. In terms of the results in the week ahead, on Monday we have Aberdeen Asset Management under our coverage, and on Friday Barclay Group is another company under our coverage. So look out for comments from our analysts on those two stocks next week. That's all from me. Thanks very much.